All right, here's a thing that no one really says out loud, but I'm going to do it. Canada has never had a housing market.
Definitely a weird way to open the episode, but I'll allow you to continue on this one.
Well, thank you so much. And yeah, weird way to open an episode about Canadian real estate, over 400 episodes in. But Dan, what I'm getting at is we've had housing policy, not markets, right? The prices, the bidding wars. The guy who made $1 million owning a semi for the last 20 years and sold it at the peak. The market is just what happens downstream of policy.
So you're saying that the bull runs that everybody cheered on and the busts that we recently cursed that took away all of our beloved equity are basically the same thing, but they're maybe wearing different hats or caused by different pen strokes by politicians, and both of them would be traceable to decisions made in a room in Ottawa or maybe in Queen's Park or some municipal government office.
Yeah, I mean, look, pretty much, right? All of this stuff is policy. Somebody somewhere signed it every single time, and that's what we have to deal with as investors and builders and professionals.
What about the invisible hand of the market, though? Like, I thought markets were free.
Yeah, well, look, the invisible hand actually, and what you're talking about is the invisible hand, the sentiment, right, that moves the economy. Turns out that invisible hand actually is holding a pen which loves to sign policy into play.
Right. And I guess, real estate investors and operators probably should give a damn about this, because said pens seem to have a pretty heavy weight on their investments over the last little bit if they change Airbnb rules or immigration or foreign buyer bans or interest rates or whatever. So if the rules that policymakers are using get written with a purpose or a certain intention for people or to try and win an election or get people to stop yelling at them, then, what's that quote? Is it Mark Twain? Like, history doesn't repeat itself, but it often rhymes. I feel like, should we look back at history and be like, maybe we can figure out what's going on, and the next move actually stops being a surprise, and we can start modeling for this stuff.
Yeah, I mean, look, that's exactly it, right? The history, and I feel like it is rhyming, and that's what today's episode is all about. We're going to go back 100 years, talk about history day in 1926 to 2026. We're going to look at kind of what built the real estate economic machine that we know, and I don't know if I was going to say know and love today, but that we know and deal with today.
Not a lot of lovers of that machine right now.
No, not right now anyways. And of course, then we're going to analyze the major policy decisions that happened along the way and how that impacted everything. So stay tuned with us as we go through that. And if you're new here, thank you so much for joining us. Nick Hill, Daniel Foch, the Canadian Real Estate Investor. Every Tuesday and Friday, we are here giving you up-to-date information, breaking news, kind of historic, lesson-driven episodes like this. If you're looking to get involved in Canadian real estate, you're in the right place. Dan, take me back to 1926, baby. Let's get in the time machine together. Let's go.
All right, so 1926, I want to buy a house. Nick, you're my realtor. Tell me what I got to do here.
Wow, I like.
Did they even have realtors back then?
Role reversal here. Well, great question, Dan. You're not walking into a bank, funnily enough. So me as, the mortgage broker today in 2026, I'm playing realtor back in 1926. But back then, if you want to buy a house, you're not walking into a bank. Banks basically aren't even in this space yet. Now, this might sound weird, but remember, this is 100 years ago. You're going to be walking into a couple different options. You got like a life insurance company or a mortgage loan company. And the deal would essentially be brutal by today's standards, okay? Your term is like 3 to 5 years. Your loan to value, only 50%, okay? So you need cash. You need at least half in cash to close. Amortization, which has been all over the place the last couple of years, guess what? Didn't exist back then. None. Interest only. And then a balloon payment. The whole principal is due at the end. Man, imagine that with today's prices and stuff. Holy.
So at the end of the 5 years, I owe the entire amount, basically. I mean, I guess that's true of current mortgages. Like you'd have to renew. They give you a new loan, so you either need to pay it out or refinance or take a new loan with them. But in that scenario, would I have to pay you out, or I guess the entire model is similar to today. It only works if I can refinance or roll it into a new term with another new lender.
Yeah, look, exactly. And I mean, that's that part of the process and that kind of mentality around things has never changed. This goes back 100 years ago. Real estate always goes up. And that was as true 100 years ago as it is today in people's minds, anyways, right? And again, what pinpoint along the peak to trough are we right now? And look, that's all fine and works until nobody's lending, right?
Yeah, and that's what I mean. You said 1926, so we go to 1926. You got 3 years. You're not even through the first mortgage term of 5 years that I mentioned, and you get to 1929, and it's You've got the Depression, the Great Depression happening. You've got this huge drought that was brutal in the U.S. I think they called it the Dust Bowl. All the soil was just getting blown away. It was like desert sandstorms throughout the Midwest.
Think like tumbleweeds blowing across
Yeah. So you've got crops failing. You've got people not having income, and then your mortgage payment is still due, and all of your interest. Either I guess you haven't been making interest payments. It's a balloon payment at the end. So this becomes due anyways at the end.
Yeah, exactly. And guess what? Now the lender's not going to refinance you because your collateral, aka the property and the equity that you have, is now worth less. And you might not have any income either, or at least you're not having the income that you were showing or making when you bought the property. This same problem that, hurt a lot of people 100 years ago, this is happening right now. And that's not really a market correction back then. That's a kind of design flaw that's starting to show itself right here, right? In the architecture of how the whole real estate economy works.
So naturally, policymakers, facing a bunch of people angry with them, what do they say? What was that? It's the economy stupid stuff, I'm probably not going to win. I'm probably not going to win my election unless I try and help some people's lives suck a little bit less. So this is where they start looking at housing and deciding that they need to do something. And they frame the prototypes for basically everything that we have fought about in regards to housing for the following 100 years in this one short stretch.
Yeah. Okay. Well, give me a rundown on that short stretch, because you're talking about a bunch of pretty big policies that happen in literally 5-6 years.
Okay, so you've got the Dominion Housing Act in 1935, which was for the first federal move into mortgage finance. So basically, they start. This is sort of laying the groundwork for CMHC to exist. Then you have the National Housing Act, which is the current version. I think all of the upzoning and financing, that's all National Housing Act stuff. It's being given to municipalities. I think MLI would probably fall into that. It replaces the Dominion Housing Act because Dominion feels very, very vintage, I think.
Colonial a little bit, yeah.
Yeah, but now they sort of getting into the mortgage business. And then 41, you get your strawberry box houses or your wartime homes, right? They've been talking about this a lot with the CMHC housing catalog and whatever, the wartime approach to housing creation. So now they are becoming a builder. This is where they had this Wartime Housing Limited was a crown corporation that puts up roughly 1,000 houses directly. So not that. And I've never really been a fan of the government being involved in the construction of housing, but not that dissimilar to what's being proposed today with some of that other stuff. And then you get rent control for the first time in 1941, which is brought in as a wartime emergency measure, not intended to be a federal political philosophy, because that's been kind of downloaded to the provinces, but that's so you had 1935, 38, 41, two policies in 41, so back to back, a bunch of stuff to try and solve what was happening in Canada's economy.
Yeah, busy couple of years. If you recall, this is of course after the Great Depression. This is after World War II, during and then after World War II, right? I mean, a lot of this kind of stuff is wartime, right? I mean, Dan, as you said it, right? The Rent Control Act, and if you're looking to discover more on rent control and actually how it affects the economy and how it affects both landlords and renters, we've done full episodes on that, so go check that out. Look, the wartime housing one is, again, one that kind of reverberates now, especially here in 2026, when, of course, getting anything approved is just painful, Dan. I mean, we just had friends waiting 18 months at the Committee of Adjustments to build a mid-sized multifamily building here in Toronto. The government becoming the general contractor is always a little, I don't know. It's a little something. You know what I mean? It usually means desperate times, desperate measures. It usually means make work project. But it also usually means we're getting housing built, but likely paying too much for it.
Yeah.
It means a lot of things. It's loaded.
Well, it's funny because, you now see the government, or it's actually, it's very poetic because, you hear about data centers, right? One of the things that I found very interesting about the world is that, I don't really have a problem with data centers. But I mentioned this on social media, and that was a huge mistake. People the biggest companies in the world are now dealing with NIMBYism and zoning issues, and and the government is dealing with the same thing, right? With trying to get these projects approved. They're like, oh, it's not as easy as we made it sound when we told everybody they needed to build more houses. And so I think, what you mentioned, the government kind of becoming the general contractor, I want to make sure that we're paying attention to that, because I think that this is a theme and a bit of a muscle that we're going to build throughout the episode. The takeaway, I think, here is that the market started as basically a rich person's game. And then the only way that they, really it was, you had to have at least 50% of your property value to be able to get to purchase something. And then it broke, and Ottawa, when they wanted houses, they introduced debt to kind of, well, they didn't get to that point yet, but then they, rather than kind of debting ahead or trying to introduce more credit to stimulate the demand side and make it more accessible for people, they just built more houses. They built 46,000 houses. And actually the article that I had up for those watching on YouTube said it was kind of interesting. They even though it was a very successful thing, and you still see these houses everywhere, and they're actually not that badly built, to tell you the truth. There were still too many workers in all of these urban areas. In Hamilton, there's people living in trailers or on the streets or whatever to try and be part of the wartime manufacturing effort. So I don't know if it necessarily solved the problem. But anyway, let's fast forward a little bit to kind of after that, where we start layering other stuff on top of that after the war ends. So take me through the next couple of decades here with the building of the real machine that we're in right now.
Yeah. So right, we had 1935 to 1941. Again, during the war years, wartime measures acts put in, stuff introduced. 1946 rolls around. The world takes a sigh of relief as the war ends. Everyone comes home, and guess what? Everyone wants a house. Remember the good old days of the white picket fence stand and everyone getting their own house and their own car and all that stuff. This is where that happened, and this is kind of the resemblance, or the first real structure being built around that kind of modern machine that we know today, right? 1946, Ottawa rolls the wartime housing and a bunch of other functions into a new Crown Corporation. Drum roll. CMHC is introduced as the Canadian Mortgage and Housing Corporation. Good friends of the show. They speak at all of our events. And Dan, as we like to point out, the only profitable government entity had to do it. Shout out CMHC.
I mean, look, if there's one thing I like, it's the government's not losing money. So if there's, I didn't need another reason to like CMHC, but
well, there you go.
They make deals easy, and they make money. They're literally the only profitable entity in the government, to my understanding.
Sounds like you're describing me. Wow.
Yeah. Nick, the deal guy. I mean, today, CMHC would be the most important institution in Canadian real estate. And I think your average person, I feel like they're definitely, I don't know if it's a selection bias, because I'm more immersed in it or whatever, not a selection bias, but confirmation bias. I think that everybody is aware of what they do and is talking about them. But I also feel like maybe your average homeowner hasn't really taken the time to think about the role of CMHC. And so let's just for the audience, I would hope I know the answer to this question, but what do they actually do?
Yeah, well, I mean, look, they do a bunch of different things, but back in 1954, they started doing things that kind of rewired the way that the country looked at real estate and investing. The National Housing Act gets rewritten, and it gets kind of two things done at once. It creates mortgage loan insurance. What's that acronym stand for, Dan? MLI, okay? Mortgage loan insurance.
Great little product.
That's it, right? Government backs the loan. So if the borrower defaults, the lender gets made whole. This is what allows lenders to offer larger sums of money at greater loans to value, greater loan to cost, because the government, big brother, is now backing you up. It also allowed charter banks to get into mortgage lending for the first time. That's 1954. Okay, so now banks are starting to play this game.
So it's so funny to like. I think just for context, because we recorded this episode already, but we had some technical difficulties. So I think the first time we recorded this, I was like thinking aloud to myself, because our pod fathers, Simon and Braden, or I guess Simon and Dan, they talk about Canadian banks a lot. They're pretty good. I mean, they're ripping. They're like absolutely crushing the index right now. Like, doing really well on earnings, and I found it impressive that they did all of that in, I was kind of thinking 1926. What I think that was like the first date we'd mentioned in the episode. So they did all of this in 100 years. Like in 100 years, they became like 80. What are they market share wise? Like 80+% of the market, right? Total market.
Crazy.
But it's like not even 100 years. It's like you're talking 1954 is that when they were first. So they did this all in like 77
75,
years.
80 years. Yeah.
Pretty. So. But when you get into like mortgage loan insurance, I mean, this is basically the government de-risking this type of lending. So you get the loan insurance. The banks aren't going to come in without the loan insurance. So Ottawa has basically made it possible. They say if you lend and if it goes bad, the taxpayer is going to eat it, not you. Which we've learned is actually not like, it sounds like that sounds horrible on paper. Even with MLI, sometimes I'm like, am I really comfortable being the taxpayer who's insuring these 95 LTV deals on super small debt service coverage ratios? But the reality is like they have insane amounts of cash, and they have not really if anybody's really, really played the housing trade correctly, it's them, man.
Yeah. I mean, if I'm betting on any government, if you can invest in any government entity, it's CMHC all day. Now, look, this is also kind of things where things get a bit dangerous, right? Okay. The leverage word, Dan, some people love it. Some people hate it right now because they are over levered. But the invention of leverage, that's kind of when it happened in this country. It wasn't really discovered. It was invented back in 1954 here. Somebody decided that the default risk on the marginal buyer should go sit on the public balance sheet, right? So socialized losses a little bit.
Does Canada's slogan, amari usque ad mari, right? So Latin for lever up and bro down, I think. Isn't it?
It's been a while since you've quoted Latin on the show. I appreciate it.
It has, actually. That used to be a regular thing. But yeah, so on the insurance side of things, I mean, you've got basically, you went from a 50% down product, which was for rich people and people who had a lot of cash laying around, to basically, this is when the middle class got into homeownership. This is when the American dream, the Canadian dream was first started, I guess.
Alive and well. Yeah, look, I mean, you're right. And it worked for millions of people for a long time. It wasn't a mistake. It was a choice, right, to move the risk from the taxpayer to make leverage cheaper. And once you can kind of see that lever being pulled, you watch it being pulled over and over and over again for the next 70 plus years.
And after that, you get demand showing up. So we have local demand being given debt to increase their buying power. So now everybody, not just rich people, can buy houses. And then at the same time, I mean, big things that I'd flag, and obviously a big theme for Canadian real estate, immigration. Roughly 1.5 million immigrants between 1946 and 1961, overwhelmingly in Ontario. So the center of gravity really in Canada's real estate started to become the Toronto region. And then on top of that, we had the first iteration of Canada's suburbs. You were starting to see suburbanization, everybody gets their own lawn. I mean, people live, it's funny because people now are 15-minute cities, and they're going to trap you in your neighborhood and build fences around you and whatever. And it's I ride a bike everywhere. It's we've been urbanized for like ever, man. Like this is, if anything, it's like conservative to go back to everybody getting into density. But anyway, so but this period of time, the invention of the car, obviously, like, and less reliance on transit. You had this Don Mills subdivision happen where there was like, master plans, separated uses, a shopping plaza. Isn't it called the Peanut? That's what it, like the shopping area is called. I'm gonna pull it up because it's funny. It's like, I think it's called the Peanut. It's like, cause it's a peanut shape in the streets. And then the car is really the foundation of this whole suburbanization that we saw.
Yeah, I mean, totally. And if you combine all those things, right, you can now have kind of cheap-ish money. You've got suburbs that you can seemingly just kind of stamp out of farmland, right? Because now it's been this kind of cut and copy. And for those watching, Dan, you pulled it up.
It's like,
if you're not watching,
like, it's funny because you say like stamp out of farmland. It's like, good luck doing that today.
yeah, well, back in the good old days here. And look, if you're not watching, just think of any suburb anywhere. Okay, this looks, suburbs are inherently kind of the copy and paste. At least these ones back in the 50s, 60s had a bit more of a yard, bit more space overall. Now it's just everything's super tight. But anyways, you got cheapish money. You got the, so much, the invention of leverage and the invention of the suburb happened at the same time. And then one more piece to the puzzle lands in the late 60s, 1967. You have the Banked Act revision that kills the 6% interest rate ceiling that existed back then.
So, like, hey, does the rate cap piece matter on this? Because, I mean, like, it's obvious to me, but, you start limiting the upside potential for rates and at the same time giving everybody access to leverage for the first time. Like,
it's a dangerous combination.
Yeah, unpack this one a little bit for me.
Yeah, I mean, look, well, there's a 6% ceiling, okay, a rate ceiling. The banks just won't lend when markets rates push past that. Like, they literally can't price that risk in. So what do? They sit that cycle out. They sit those deals out.
It's like credit contraction, right? It's kind of what you're seeing right now, yeah.
Yeah, but you know what? You kill that ceiling. You get rid of that 6%. And again, we're talking about 6% rate ceiling, not a 6% cap rate. Very different, okay? If you kill that rate ceiling, the banks come all the way in and become the dominant mortgage lenders in the country, which has never really changed and are becoming even more dominant again in the banking space today.
So, okay, so by 1970, let's say, you've got the car built. I'm going to use the car analogy because we're talking about Don Mills.
I like it.
Suburbs. I'd say like it's a sick like vintage GM, like maybe like a
land yacht type of thing.
Yeah, exactly. And got the wings coming off of it. Johnny Cash.
No one's wearing seatbelts.
Yeah, Danny Zuko's hanging out wearing a leather jacket, hacking
there's
darts
an
out the side.
There's an
ashtrays,
built
some
in.
8 tracks. Yeah, okay. So cars assembled. Yeah, Crown Corporation is eating the default risk. Banks are fully in the game. Suburb blueprint is ready to go. Like, we're like, okay, we figured this thing out, man.
What do we do now?
The next stretch, Danny Zuko hacked too many darts and just steps on the gas pedal, maybe.
Okay, so now we are closing out the 60s. Talk to me about the 70s, 80s, and 90s, Dan. A whole bunch of stuff happened. 1971 to 1990. Let's talk taxes, shelter, and kind of the first real cycle that we see, right?
I like the tax piece because I was out with a guy from PwC last night, and we were talking about taxes. I have an episode coming out with him for their emerging trends report, so stay tuned for that. He's actually interviewing me, so it's going to be a cool one. But tax change, like what do real estate investors hate more than anything? Tax, man, like straight up, honestly. And so the accelerator really that Danny Zuko steps on in his old 7 Chevy Bel Air is a tax change, which nobody really like thinks about tax reform in relation to housing, but this is where you really get in. It sets it apart from every other asset class.
Totally. And I think what you're talking to, and if people haven't figured it out yet, it's the capital gains tax. Okay, 1972, capital gains is introduced to Canada, and it kind of does something unique at first. It carves out the principal residence exemption. So the home that you own and live in is exempt from that big chunk of taxation. Not that we're not taxed everywhere else way too much, but hey, we'll carve out your primary res for you, all right?
So, like, we've discussed this a couple of times in the context of like global, what are capital gains rules all around the world. Like, this doesn't make Canada exceptionally special by any means. Like, every country has some version of that. Why is it such a big deal for Canada?
Yeah, it's a good question. I think you got to go a bit deeper. It's kind of what's already stacked underneath that, right? You spent, let's say, 20 years making leverage cheap, and not only cheap leverage, but insured leverage. Now you make the same asset the single biggest tax shelter that any normal Canadian could really get their hands on and use as kind of a wealth building tool. Every other gain gets taxed like crazy, but your house doesn't. So, guess what's looking real attractive?
So the thing about economics is it assumes that people are rational consumers. I mean,
Well,
COVID, yeah. Like, well,
that's the
COVID was
first
crazy because,
mistake.
like, you could borrow at net negative interest rates. Is like, inflation was 7% and you could borrow at 3. So, like, what was it would be the rational thing to do would be to lever up and buy like literally anything that was subject to inflation, and that would have been a decent trade as long as it didn't depreciate. You go back then, and what happened? I mean, it literally. What is the Munger quote where he says, Charlie Munger? He says, "Show me the incentives, and I'll show you the outcomes." So,
Yeah.
what happened? Any rational economic actor, which is pretty much all Canadians, I think like 70% plus home ownership rates at that period of time, everybody put every spare dollar into these friggin' suburban houses and their cars to get them there. And so you had bigger, nicer houses, hold it for 30 years, walk away with a tax-free gain. You were more incentivized to buy the biggest house because it would amplify the dollar magnitude of the capital gain that you earned. And think was like the Canadian housing trade for the last 60 or 70 years, which basically means like the whole Canadians are obsessed with the real estate thing isn't really some like Western world cultural phenomena. It's quite literally exactly what policy was designed to create.
Yeah, man, exactly. Now we're getting to it, right? Not a market, but policy, right? It's all about policy output. And now for the demand side, okay, the supply side for one brief window, we actually get it right, right? Mid 70s, we've done full episodes on this, the MERB program, the multi-unit residential building, MURB. We won't belabor it today. Go check it out. We've done full episodes on it. But that was a tax incentive for purpose-built rental, similar to what we're seeing now. Basically, the only 2 times in Canadian history that this has really happened. You could write off the losses against your other income. So suddenly, you're more mom and pop, good old regular investor. And we're starting to do little syndicates and are funding apartments and buying and building some bigger stuff than they ever have.
Doing tax fraud and getting the program shut down.
Hey, yeah.
I mean,
well,
it was such a yeah. Well, like, I mean, you could go build or buy an apartment building and deduct it against your income, right? So
yeah.
it was like if you were a doctor or a lawyer, or somebody who was making like big bucks, you could use those expenses against your other income. And so this worked really well. Like a huge share of the rental stock that we live in, that we see in our cities, all of those like 3-wing buildings that, the era of the buildings I'm talking about. You see them all over Canada, concrete towers, all of that stuff is MERB era. And then we killed the program by, I think it was 1981, the program had winded down. And the piece that I want people to really sit with this is because this, kind of runs the entire rest of the episode, is when the MERB program died, purpose-built rental construction basically flatlines until present day, like for 40 years. So now you're just seeing the charts getting back to those levels because of MLI.
40 years, right? Like literally 1981 rest in peace, MERB, to 2022, 1981, 2022. That's crazy. And look at the 2 dials in the mid 70s where we're here, right? Home ownership just got turned into the country's best tax shelter. That's demand up. And Ontario rent control, 1975, that's supply down. Same couple of years.
Yeah, and we see this constantly with like switches on and off, policy volatility, right? And so like it's worth paying attention to it every time that it happens. So let's maybe we'll do a little bit of a history and geography lesson here, because we did see a lot of sort of some changes also happen in geographic demand. So I mean, like you go talk to like a boomer or like older in the US, and like when you tell them about Canada, they what do they think of like Canada City? They think Montreal, right? But then during like the 70s, you had this October crisis with the FLQ, you had the War Measures Act, and like real political violence happening in Canada. I think there was like bombings of some bridges and stuff. And then you had Bill 101 in 1977, which was the language law. And Montreal kind of, I mean, well, I think everybody knows what happened there because you talk to anybody from the next generation and they're thinking Toronto.
Yeah, exactly. I mean, Montreal went from the sexy hot spot world city, the known Canadian city, and then all those things changed it, right? I mean, and those things are usually the things that have net negative effects. The combined effect of all that led to an exodus of head offices out of Montreal, and a lot of them, of course, landed not so far away, a little west in Toronto. Montreal was once the financial capital of Canada, but that baton also got passed to Toronto and never got passed back.
And then sort of the same period of time, I think like 73, 79, you had this like boom happening. I think if you go back and look at, I'm going to try and pull it up when you're chatting, but there's like, you go look at housing affordability charts. There's a period of time where like houses were more expensive than in like Calgary than anywhere else in the country, I believe. So 73, 79, Calgary and Edmonton were just ripping, right? And then you had this national energy program that the government introduced in 1980, which kneecapped Alberta right as oil was rolling over, which was a brutal bust. And this was like really those violent market cycles that you would see in the Alberta real estate market, which it seems like they're a little bit detached from now. Like it's less reliant on the oil trade, but I think it's tough to say because oil's ripping right now, and Alberta is also ripping independent of oil. Like, everybody's just moving there because so anyway.
But look, I mean, the thing about those markets, right, Alberta and then the major markets there, they're both downstream of decisions that are likely made outside of that province, right? Especially when we're talking about oil. I mean, the whole country is hit with a rate wall in 1981 where mortgage rates, Dan, again, another drum roll moment here, 21%. Okay, imagine paying 21%. That is absolutely insane. But that, if you look at the Fed chair back then, that's Volcker doing what he did, which was a really tough move. We're not going to get into American economic history, but this was a really tough time in the 80s where really difficult decisions had to be made by Volcker and his administration that crushed inflation south of the border, and Canadians kind of dealt with that, right? I mean, it's the same thing that we're dealing with now, whereas anything major happens in the States, well, it has a pretty big impact on us up here.
Yeah, I mean, I think the central banks, I mean, you're seeing it right now. Like U.S. Long-term yields were ripping. They've dropped down quite a bit today, like as the day of recording this. But if Bank of Canada can't stay relatively in line with the U.S., you start to risk Canadian dollar getting blown out and some imported inflation. And there's economic consequences. So after that period of time, and that was kind of like the long-term peak of interest rates, right? Like if you look at the interest rate chart, it's basically downhill from there, like into the global financial crisis, basically until present day. It was like the first time you really saw, I mean, breaking that downtrend from 20% down to zero. So let's go through the first iteration because we know what happened, right? So rates come down through the 80s. People are like relieved that we're no longer trying to get mortgages at 18%. And then Toronto basically goes vertical because people, well, back then people were piling into it at a fear of inflation, right? They felt like it was an inflation hedge. And then it breaks. I think it dropped like 30%. This was our last really like true major housing cycle in Canadian real estate. And then there's, the piece that I think that should scare people a lot when they think about what happens during these cycles. And you kind of come back with this sort of hotter economy where they're comfortable letting inflation run a little bit hot, is that in nominal terms, Toronto took 12 years, didn't get back to 1989 peak until 2002. In real terms, adjusted for inflation, I think it took 22 years. It was like add 10 years to that. I think it's 2012 that it took to get housing back to the 1989 peak if you adjust for inflation. So violent, I mean, we're in one right now, right? Violent market cycles.
Yeah, look, and that was kind of like the first real modern market cycle that we saw, right? Like a genuine mania, and then the grinding, and then like the decade plus long hangover, and the average person getting screwed, and the people with money and intelligence and that dangerous combination of, a higher risk tolerance as well. Absolutely crushing it during that time. So let's move on. Let's get to the next little piece here, Dan. 1991 to 2000, where we see a bit of deregulation and levering up.
Yeah, so you go 1991, I guess we come out of the hangover on that market cycle, and you would think that policymakers would be like, hey, what can we do to avoid that type of situation again? But the response is absolutely not cautions. So take me through this thing.
Yeah, some might even call it the opposite of caution. The 90s and early 2000s were kind of like a steady bipartisan project of making it easier and easier to borrow money. Okay, let's go through a bit of the list here. 1992, we see the home buyers plan where you can pull money from your RRSP that's tax-free for a down payment. Retirement savings pointed straight at a house. The mid-90s, we see 5% becoming normal. Right, we opened up this episode, Dan, with 50% down and no amortization.
Funny,
45%.
They're like, oh, nobody can
dude.
afford. Like the market's so slow. Like rather than letting it heal, it's like let's just stimulate demand and make it possible for people to. There was a 0% down minute, I think. For a period.
Man, yeah. Well, also it's why didn't we ever just be like, hey, why don't we figure out how to get people making more money? Let's stimulate the economy instead of making debt cheaper, right? 2001, CMBs, Canadian mortgage bonds. And then 2006, the 40-year amortization, zero down. This is the loosest that Canadian lending has ever been.
So I think that, it's easy for us to just get angry at Canada and act like we're irresponsible. But I think a lot of this was just the world modernizing mortgage finance. Like much of the developed world loosened up mortgage credit in this window as we were kind of moving towards that Western world dream of home ownership sort of thing.
Yeah, no, look, you're totally right. I think there's a lot of this has to be taken with grains of salt, of course. But Canada did lean a little harder than most, to your point, right? And the other thing we did here that was a bit more unique is we backstopped it publicly through the CMHC vehicle. In a lot of other countries, the lender eats more of the risk, and a lot of people think that's what they should be doing, right? There's risk to this business. Why do I have to pay if something goes wrong? But here, we kind of put it back in the public balance sheet. So when we loosen with a government guarantee underneath, right? We talked about that kind of risk stack earlier. Well, this goes, and that makes that whole thing go further and faster, which can be dangerous.
And there's another thing in 1993 that nobody really remembers, and it matters, I think, that, during that period of time, Ottawa basically fully exited federal funding for new social housing. So you had MERB. It wasn't a huge component of supply, but at this point, there was nothing left, right? So you had MERB that was killed in 80s, and then 93, the Fed basically stopped building social housing. Those were the only engines that we had for non-luxury, non-ownership supply, and that all switched off within 12 years of each other and kind of created the path for what Canadian real estate investors started doing, being the backfilling for that role that no longer existed.
Yeah, and look, we spent the next 30 years kind of genuinely puzzled about why there's no affordable rental. Well, if you're not building any, how do you plan on getting any, right? Supply is off, demand is now on, and here's the other underrated one that I mentioned, Dan, the Canadian mortgage bond, right? Tell me about why this is so important and what it is.
So if you just follow the money on this, banks issue you an insured mortgage, and instead of holding that for 25 years, it gets pooled in with thousands of others, similar to what you heard happen in the U.S. with the Big Short, where banks could buy insurance or buy swaps on these loans. They get pooled into a bond, right? That bond investors, a Canada mortgage bond. Nick pays attention to this stuff a lot because of CMHC MLI Select, but the government puts a guarantee on it. So now all of a sudden you get foreign capital, you get pension funds, not just Canadian, global pension funds, huge investment banks, et cetera, able to start buying it because it is about as safe as a government bond. The government's already guaranteeing it, and it pays a little bit more. I think they're 50 bips above the Canada 5-year, right? So,
yeah. So look, I guess what you're saying is when the bank gets its money back the same day and can kind of lend it back out, it's a little bit of a revolving door policy.
Yeah, basically, they've created a conveyor belt for banks. So banks can originate these loans, but it also wires the global bond market directly to your mortgage. So if you're a buyer or seller, you are now attached to the plumbing that makes cheap mortgage money flow, which is arguably more important than any single down payment rule. And almost nobody's ever heard of it. Like nobody, unless you're in MLI, you don't really think about mortgage bonds or anything like that.
Yeah, it's a lonely thought. There's only a couple of us out here thinking about. But look, that kind of craziness feeds all of that feeds directly into the mid 2000s, right? And generates more of this kind of craziness in 2006, the high water mark, right, where there's 0 down, 40-year amortization, your debt's insured. We are at that moment running basically the same playbook that's about to blow up in the U.S.
So why didn't we blow up with them in the '08 crisis?
Yeah, well, I mean, look, I'll keep this short because we've talked about this a bunch and it'll come up kind of throughout the rest of the episode here, but partly a bit of luck, but also because we pulled back the 0 down stuff pretty fast. Like our origination methods were much better and less fraudulent up here than the ridiculous U.S. subprime machine that was built. The banking regulations were pretty good. Yeah, I mean, look, we came right up to the edge of making it happen.
So before we leave this era, the map is going to move again, and this time it's a little bit more global. So 1997, Hong Kong reverts to China, and then the years around the handover you start to get a lot of people migrating, and they're part of the British Commonwealth, so it was a very easy place for capital to move out of there and into Canada. And where does that start going? Well, a lot of it started going to, don't need to explain this to anyone, the Lower Mainland, right? This is Vancouver really starting to decouple from the rest of Canadian real estate and trading less on, they basically just completely left behind local Vancouver incomes and more paying attention to, when Hong Kong is rich global capital. So, that's like the money.
That'll change the market. Yeah.
Yeah.
Well, look, the arrow kind of keeps going, right? Montreal to Toronto to Vancouver. We start to see the genuine globalization of Canadian housing markets come into play. And that kind of, like the one breath version of this is, we looked at the early 90s crash, decided the lessons were borrow more. And then we spent 15 years turning every demand dial to 11, a little Spinal Tap reference there if anyone knows that great movie. And switching the supply engines off, right? So, like, what did we expect? But the story isn't over yet, Dan. We are going to pause it here for this episode. We just took you from 1926 all the way to 2007, 2008. I love when we do these two-parters. It just feels like, we don't do a lot of like cliffhangers, suspense on the show.
Well,
right?
You didn't believe me when I said that the original recording was like over an hour. Let's just do. There's like 2 more minutes here before we can get our old recording back. So let's just. Well, if we're gonna rip through this really quickly. We'll tease the next segment and then we'll go. So 2008 to 2019, you've got the global financial crisis, right? So the U.S. housing market implodes, and Canadians were just sitting around like we're like so much better than you, but it was because we could drop our rates to basically nothing, right? Government starts tapping the brakes a little bit, and the brake is Finance Minister Jim Flaherty, where, between 2008 and 2012, he tightens the insured rules 4 separate times. So they went down from 40 years to 35 to 30 to 25, plus a cap, no insured mortgage on a home over $1 million. So he's basically unwriting a lot of the 2006 stuff one step at a time. And the prices were still going up because the insured channel, like that was only the insured channel, but everything, people only needed that if they were first-time buyers and low down payment and whatever. CMHC bond plumbing was still humming along. Immigration was steady, and we're still not building any rental housing. And people now have wealth that they've created. And then, you kind of fast forward to present day, right? So that's where we'll get to the next episode, I think.
Stay tuned for part 2, baby. Let's go. 2008 to present day. We'll see you on the next one. Thank you so much for listening. If you found this remotely entertaining, valuable, or even annoying, leave us a review, leave us a rating, send your questions in, come out to an event. Thank you so much. As always, we'll see you soon.